Most traders who study smart money sooner or later face the same problem: when exactly to enter a trade. On the higher time frame, everything looks logical. There is a zone of interest. You expect a pullback, and you plan to enter the continuation of the trend. But when you switch to a lower time frame, everything becomes less obvious. In one case, the price reacts perfectly to the edge of the zone. In another, it goes down to 0.5 or deeper. And sometimes it breaks through the entire zone and only then reverses. How to understand that the zone will really work? Where exactly to wait for a pullback? And most importantly, how to enter if the movement has already started and you are left without a position. Today, I'll show you how, with the help of order flow, you can not only build zones, but also understand when algorithms really work in them. We will analyze how to distinguish a real reaction from a fake one, how to find entries with a confirmation point, and how to join the movement if you did not make it to the very first point. I'll show everything on my trades on the following assets: EURUSD, GR40. If you already work with liquidity, this video will make your trades more accurate and logical. Before we move on to charts and entry points, let's figure out what order flow is and why it is difficult to understand where to open a trade without it. The first example is a classic downward structure. Everything seems clear. The price is updating its lows, and the movement is directed downward. Within this trend, there may be reactions to local areas of interest, but this is secondary. The most important thing here is that the highs, which are not being updated, are gradually accumulating liquidity behind them. Each such liquidity pool is a potential target for large players, and the more such highs appear, the higher the probability that they will be removed, and the entire downward movement will be reversed. This is the basis for understanding how liquidity accumulates in the structure and how it affects the logic of price movement. But now let's see what happens when order flow really starts to work, and the structure no longer directly controls the price. The downward structure remains, but one important change occurs. The price continues to form a new low, and the trend seems to continue, but before that, liquidity is withdrawn from the previous highs. This is the key point. In this phase, the market begins to work with liquidity within the structure. The high is no longer just a pool of liquidity as in classic movement. It becomes a target. It's being withdrawn. This is a sign of order flow. Such zones are considered protected, and unlike the usual structure where each maximum is a potential trigger, here the work with liquidity has already taken place. It's at such points that we can not only open a trade, but also join the already ongoing movement without hiding the stop behind the very first withdrawal of liquidity, because this zone has already been worked out. But it's important to understand that order flow is not formed just like that. It always works with a specific goal: to bring the price to a certain zone of interest, remove key liquidity, and create momentum. These are not random movements. This is a purposeful algorithm. The flow of orders begins to form after two clear confirmations. The first is manipulation, liquidity withdrawal or price imbalance filling. The second is reaction. The price must update the extreme in the direction of movement. If both conditions are met, order flow is active. At this point, we can determine from which liquidity the movement began and what goal the algorithm will strive for. But this model also has a cancellation rule. Order flow does not continue indefinitely. If the price has already fulfilled its task, for example, it has entered the zone of interest and changed its structure there, then the previous scenario is no longer valid. This example illustrates precisely such a situation. Order flow drove the price to a specific zone. After delivery, the minimum is no longer updated, and instead the maximum is removed, and the market begins to move in the opposite direction. This is a reversal, a cancellation of the scenario, and a signal to change direction. Now let's apply this logic to a real chart and see how to use it in practice to find specific entry points. Here is EURUSD. First, the higher time frame. We see a clear upward movement, and most importantly, the price is already in the zone of interest. In this case, it's a fair value gap. Logically, I want to open buy trades, but simply entering a trade is not enough. I need confirmation that order flow is really working here. The first thing I pay attention to is yesterday's low, the so-called PDL. It's not a part of order flow, but for me, it's an important condition. Before opening buy trades, I want to see this liquidity removed, because after such a withdrawal, the market often gives you the opportunity to join the movement at a more favorable point. The chart shows that the PDL withdrawal occurred during the Asian session, after which an upward movement began. But I don't trade during the Asian session. Therefore, my task is to join the movement later, either in Frankfurt or in London. To do this, I need to understand whether order flow has been launched, and most importantly, it must have a target. In this trade, the target is PDH, yesterday's high. That is, I expect the high to be removed. Now I need confirmation. The first confirmation is the liquidity withdrawal and the continuation of the upward movement. Next is the second confirmation, another liquidity withdrawal without updating the low. All this confirms that order flow is active. On the third confirmation, I open the first buy trade. The goal is to take out yesterday's high. After that, the fourth confirmation appears, and I open the second trade. This is an algorithm where each step has its own logic and confirmation, and new opportunities appear on the chart even further down the line. This is the essence of order flow. You don't guess, you work within an algorithm. A clear goal, an understandable stop, protection beyond the zone where liquidity has already been withdrawn. This makes your trading much more systematic. While we wait for the trade to close, let's summarize a little. To trade using order flow, it's important to understand a few key things. First, the goal. Order flow does not appear out of nowhere. It always has a direction. In this trade, the goal was clear, to remove PDH, which is the previous day's high. Second, confirmations. There must be at least two. This could be a withdrawal of liquidity or a sharp imbalance, but the most important thing is that this must be immediately followed by a price reaction. Only then can we say that the algorithm has been activated. And thirdly, areas where liquidity has already been removed. Such areas are considered protected, and that is where you can hide your stop. Now let's apply this logic to another asset and see how order flow works there. Let's move on to the GER40 index. Here I want to show a slightly different situation, so you can see how order flow helps you find an entry even when the market looks unsuitable visually. This is the same trading day as on EURUSD, but unlike the smooth upward scenario, here we see a sharp drop. The movement is aggressive, and it would seem that buying here is a doubtful idea. I open the chart at the end of the London session. On the higher time frame, there is a clear zone of interest, and I assume that the algorithm's goal is to bring the price there, removing London's liquidity along the way. This is just a hypothesis so far, but the logic is already there. Next, I switch to the lower time frame and start waiting for confirmation. The first confirmation comes quickly. The price sharply removes local liquidity and immediately bounces back up. There is a reaction. A potential reversal begins, but I'm not entering yet. This is only the beginning of the scenario formation. Then the New York session starts, and the market gives me a second confirmation. Another upward impulse, the lows remain protected, the structure shifts, the scenario is getting stronger, and here comes the third confirmation. This is my entry point. I open a buy position, set a stop beyond the zone where liquidity has already been withdrawn, and set a take profit at the London high, as I planned from the very beginning. Despite different assets and different goals, the logic of the work is the same. Order flow gave me a clear understanding of when the market is ready to reverse and when it is worth opening a trade. This is the essence of order flow trading. You don't just look at the price, you understand where it's going and why. It's not easy to understand such situations at first. It takes practice and experience to confidently understand where the market is really building order flow and where the movement is still raw. If you think this is too difficult for now, you can start with a simpler tool. This is the OWL indicator. It has one clear entry point, exactly when you need it. You open the chart, see the entry zone, stop and take, and just go for it. Only work with the trend with understandable risk. Important, OWL is not related to liquidity and smart money. It's a separate approach, trend-based, with strict risk management. It works equally well on crypto, Forex, and the stock market. And to make it even more convenient, after purchase, I'll send you OWL Helper. It is an expert advisor that automates entry, calculates stops and takes, and makes trading easier. The link to the indicator is in the description. To get OWL Helper, just message me on Telegram. Hi, send me the OWL Helper Expert Advisor. I bought the indicator and the date of purchase. Order flow works the same way in the cryptocurrency market. By understanding its logic, you can find great trades, even in conditions of high volatility. I use EVDEX to trade crypto. It's a decentralized exchange where you have complete control over your funds. No intermediaries and no account freezes. No KYC is required. Just connect your wallet and trade directly from your balance. Commissions are lower, speeds are high, and the interface is on par with top centralized exchanges. There is leverage of up to 100x, but it should only be used by those who know how to manage risk. I'll leave a link to the exchange in the description. If you want me to do a special video on the crypto market and show how order flow logic works there, let me know in the comments. Order flow is an understanding of where the market is taking the price, what the algorithm's goal is, and where it is safe to join. The system is simple: goal, confirmation, and work only where liquidity has already been removed. If this video helped you better understand the market, please like it, write in the comments what you think about order flow logic, and subscribe to the channel. In the next episodes, we will continue to analyze real trades and scenarios so that you can trade with the algorithm and not against it.